Hey everyone, it is Thursday, June 16th, 2022. Welcome to Tech to Quick Takes. I'm your host, Alex Riley, and I'll be joined shortly by Alex Norman to break down some of the headlines from this week. Today, we're going to take a deep dive into the recent layoffs that have been impacting the tech sector and what that means for the Canadian tech ecosystem. So, joining me now is Alex Norman. Hey, Alex.
How's it going?
Good. How are you?
Pretty good.
So, been a little bit of a wild week in terms of, or I guess recently leading up to this week, with layoffs affecting the tech sector. So, hoping you can share your opinion and thoughts on what this means for the Canadian tech ecosystem specifically. There's a lot to unpack. So, why don't we begin with what companies have recently laid off a large portion of their workforce?
Well, first maybe let me go to context here. Like I said previously, we don't go, our plan is not go week after week and talk about the layoffs and talk about what they mean, because I
Mhm.
think this is more response to the macroeconomic environment and the funding environment than any individual company. Now, if there is a company we think that imploded or did something wrong, we might get into that. So the list of companies offhand,
Yeah.
Um, you know, Simple did announce some stuff yesterday. I think Swift was in the paper. Um, there was that Global Mail article. Do you have that list there?
I don't have it in front of me, but there was quite a few actually that were impacted that listed layoffs and hiring freezes as well. I know Simple was on that list. I was actually going to ask you because that article specifically touched on how it was really ravaging the US tech sector, but obviously it's a trickle down
Yeah.
effect to Canada. So do you
So
think it
so
will be as bad in
well,
Canada?
look. So look, you can see I can't even remember the company names because A, there's a lot, and B, I don't think it's really that um relevant for to remember exact names. I think what you have is, I think companies here are facing the same funding environment,
Hmm.
which means that if you were a late stage company hoping to get someone to invest at a higher valuation and all you are optimizing for was growth, that's no longer a possibility because the investors that are investing in that are either not investing and they invest globally. So what you're seeing is the big numbers you're having are from late stage companies. And I think you're going to see that across the board, unless the company's been very slow to hire or is it growing extremely fast and is not worried about a possible recession. So I think even the companies that haven't announced it
Hmm.
or announced or having mute, you can imagine everyone's revisiting their hiring plans at minimum. So we'll probably slow down hiring, and probably sometimes saying, "Are we investing? Is our team investing in the right place?" Um, I think those are questions. I think you'll see more in the States because those get more attention, but I think across the board you'll see it here too.
Right. And so just to maybe touch on, or as you say, double click on the ones that have kind of like quietly been, going through these cuts, but maybe haven't announced it. So some fast growing tech companies have been part of that quietly cutting jobs. So why have they done this? Maybe like why have they
So
chosen to stay quiet about it?
it's not a morale booster to say you're laying off people,
Yeah.
and there's still you may want to keep confidence in if you're dealing with lots of enterprises that you're not on shaky ground. So let's go through what's happening, maybe more details. Let's give you an example. So
Mhm.
go back 12 months ago. Let's say you're a SaaS company growing really quickly, and you get to 20 million revenue or 30 million revenue. The market was saying, okay, we're valuing your growth. It's so fast. It's so great. We're going to give you 40 or 50 times valuation. So that's okay. Let's take number simple. 30 million times 50, you're now $1.5 billion, you're a unicorn. So you're being told you have to keep on growing to justify that valuation. So what you do is all of a sudden you have 200 open positions. You're investing in the next product that may or may not work. You're investing in a sales team. You're investing in product. Now the market's reevaluated what a company is worth to the public. If overall average, I think for SaaS companies was like 20, and it's down to like 6 now. So they're saying, okay, instead of being valued at, what did I say, 350 times revenue, your next round will probably be at 20 times revenue. Still very good. But now to get to even break even the same value, you have to go from 30 million revenue to
Mhm.
75 million revenue. So all of a sudden you're like, you have to look at your plans and go, okay, we don't want to have a down round because that means lots of employees will getting rewarded and lots of employees will leave. There'll be a fracturing of belief in the momentum of the business.
Yeah.
So you go, okay, what's the first thing you do? The first thing to do this without making something go, look, we had 200 open positions. You know what? We know we can take 10 more salespeople. There'll be an ROI on this team. We know a saleswoman will get us X dollars. So we'll keep those open positions. Well, 30 of those positions were for some nice features of product discovery. We're going to cut those because we don't have, so we won't hire for those. So all of a sudden, even without making layoffs, you've now lowered your expected burn or lowered your expected burn. Next, you go through your team and go, okay, I do believe we can go from 30 to 75 million revenue. We were originally planning on doing this in 18 months, burning a lot of money, but let's get there over 24, 30 months with get there in a slower, longer time. And to get there, we're going to have to lower our burn. So let's cut up the teams where there's not immediate impact. And our team, the team that's, instead of doing a bunch of stuff in parallel, we'll do stuff sequentially. So that's the logic behind it. Now, why don't you make these huge announcements? Or why haven't you done this publicly? First of all, if you were your burn was going to be driven by growth of people, now you can just avoid it by not growing.
Right.
Second of all, you might not have those answers of where can we reduce those people, and you don't want to, so you haven't made those announcements yet because you haven't done it yet, or you might be saying, screw this, we're going at 10% a month, 15. We're going at 15% a month, so we're doubling our revenue every 4 months, roughly. So if you're doubling every 4 months, you go, okay, in 12 months we'll be at 8 times our size, so we'll be at 160 million. And so they might be in a position where they think they don't have to grow, they don't have to slow down. Now, the one thing that's complicating everything beyond valuations is, are we going to a recession? Lots of people think we are. And then I think you're going to see different companies affected in different ways, right? So is this something that's a nice to have, a need to have? What are my customers doing? Am I selling only to early stage startups? All these questions are going to affect your how you cut people, and then when you announce it. If you don't want, generally you don't want to announce it publicly, it just doesn't look good.
Right. So obviously not a morale booster for anyone that is currently working for these companies, and not intriguing for anyone that maybe has their eye on joining or pivoting to a company like this. And yeah, so obviously the focus is where the demand is, but unfortunately that means a lot of folks are being impacted in terms of those like layoffs or hiring freezes or anything like that. I want to flip this more to a perspective from a VC. So are VCs concerned about, these layoffs or this news? How would they be maybe thinking about this and approaching it?
So the VCs are probably encouraging these layoffs as much as they're involved. I think from the VC's perspective, it depends where they invested, where they are in the life cycle of their fund. The later stage VCs are, again, this is all driven by valuations, right? So let's go. I invested in $1.5 billion valuation of this company. It's growing really quickly, but God damn it, they're only get to 50 million next time. They're going to probably raise that $1 billion. It's going to be at less value. So I'm going to show negative returns versus someone that invests in that company at 10 million valuation, the first check in. It's like, okay, my returns aren't as great as they were before, but I'm still up way in the money. So I think the biggest concern as a VC is, do these companies are they going to survive? Are they going to produce a return for me? And so what they look at is they've gone through their portfolio, talk with their founders and ask them to say, are you in the right path? Is your burn appropriate? Should you do less? Should you do more? And those are the conversations they're having behind the scenes. I think that's, from a layoff perspective in companies, they want to make sure their companies have a chance of surviving and thriving. And that's always what they want. It just, now it's a different dynamic. Before it'd be like, hey, how fast can you grow? Let's be the market leaders. Let's not get overtaken by someone else. Those concerns aren't there now. It's like, let's make sure that you have the right to earn more money or be cash flow positive, and that you will, the portfolio companies will be strong.
Right. So the second quarter of this year has already been the biggest 3-month period for layoffs since the outset of the pandemic in early 2020.
I don't believe that, by the way.
Do you see this slowing down?
I still think it's going to get worse.
Still think it's going to get worse.
Again, the assumption is we're going to recession sometime soon. If we go into recession, it's going to get worse because there's probably areas of technology that have been slowed down because, return to normalcy.
Right.
But if the consumer stops spending, which maybe they have already, like you can see other industries where just the customers, either enterprise or consumers, are reacting different. And so that's going to put natural, instead of having tailwinds, there's headwinds. And if there's headwinds, you're going to see people have to readjust their plans again. I think lots of companies are trying to get ahead of it. I think there's also some sectors which are going to see less interest from investors or more questions about their business models, which will make them be more frugal with their cash as well.
Right. And understandably so, there might be a little bit of fear or concern for anyone that is, involved in tech and is seeing the layoffs that are happening. Do you perhaps have any advice or peace of mind that you can offer for people
Oh,
who have been laid off or maybe are worried that, yeah, as you said, it's getting worse?
so I don't think this is different than any other time. People, even in good times, people get laid off. And
Yep.
again, I think this goes to, I think there's mental, physical, and financial health. And this is not advice necessarily to follow, but like, I think the first thing is you need to make sure you have the right mental support. And it's like, because even when things are going well and stuff goes off the rail, like, I just think no matter, you almost block the news out and just deal. You can't control what's going on. So know what you can control and think. And most people in tech are lucky. They have served, there's, despite everything, there's more jobs out there being hired than fired. There's still a shortage of talent in sales
Hmm.
and engineering and product. You have good skills that people want to hire. So, maybe you won't get all the perks you had before, but you're not in a sector which is going away.
Right.
So keep above the wing, make sure you think right. I think then the other thing is don't act irrationally. Just don't jump to the next opportunity. Like, I always would say the same thing, no matter what the market is. Think about what you want to do next. Make sure you go to the right thing that's good for you. And I think the third thing is, if there is a higher chance of being, made redundant, or having a gap in your earnings, you should be able to make sure if you can prepare for that, right? Like,
Mhm.
make sure you have enough. Like, don't live paycheck to paycheck. But I don't think that's different than any other time. And I guess I feel very like this very trite advice, and I don't know if it adds value, but that'd be my approach. Like, I don't think anyone in the tech sector will have long layoffs if they have the skills.
Right. So as you said, like there are still in demand skills. People are still looking for tech talent. So for those that are looking at this as an opportunity, if you're thinking of joining a startup, how should you be thinking about this as an opportunity?
Well, so I think when you think about joining a startup, what are you trying to get? You're trying to get financial gains,
Growth
and
opportunity.
yeah, and trying to get a growth opportunity to be, better. And third, you're probably looking to impact your job has on the world,
Yep.
right? And I don't know, you may put those in different orders depending on your individual desire. So I think you should still look at the lens that you would be for. Is this a great growth opportunity? Will I be able to learn a lot? Will I be able to contribute a lot? What's my package look like? And then
Mhm.
what is the impact of the company, right? Hey, maybe you want to work at Jewel and help people vape, so be it. But like, if that, again, so first, the alignment with your values does not change. The ability to be surrounded by great people, learn more, advance your knowledge and your skill set doesn't change. I think what changes the compensation package
Right.
is to better, if you're relying on the equity to act as a boost to your cash comp, understand there's two things that you should say. A, from the cash comp, you should understand how much runway the company has, how good their business model is, what progress they're making. And likewise, you should ask about understanding the options, where they're priced. Like, I think in a bull market, everyone's like, okay, yeah, they sort of should have spent time to better understand what their equity was worth and what they were offered. I think, in a bull market, even if you didn't, you would generally do okay. But now I think where the market's getting more choosy, you need to understand, how long can this company pay me given the current, and what the assumptions are behind that. And also, what are these options, these options restricted, what's the value to this, and what do I have to believe there? And that,
Mhm.
and it's funny because you can, and that might be less important to you or more important to you depending on your personal needs. Like, hey, I've got this company that's doing climate change, super talented, it's team of 10. I'm going to learn something, and I know they just raised money for 18 months, I'll roll the dice. Versus some people might be, okay, let me just optimize for the pay.
Right. One of the things I've been hearing too, just from folks, friends, people I know in the tech sector that have an idea, they're trying to launch a business, trying to grow a startup. If you have an idea, should you be starting a startup right now? Is this a good idea?
If you can afford to, yes.
Hmm.
Like, I actually think it'll be harder to raise money, but everything else will be a bit better. Less people will raise money, so you have less competition.
Right.
Less pressure on pure growth. You'll need to still show metrics, and I think the amount the, the ability to raise money is gonna be harder. The ability to raise follow on will be harder, but like, There should be more great talent available. There should be more
Mhm.
people. There should be there's just more slack in the system in a situation like this. So everything but capital is more abundant, and then if you can obtain the capital for your idea, um, it should put you in a much more competitive advantage than it was 12 months ago, where everyone could raise money. So I think
Right.
if you have the idea, you have the skill set. The one thing you might do differently now is you may try to syndicate the idea with potential investors before to see what you need to raise to make sure that you have a realistic chance of raising.
Right. So I was kind of digging more into like, how should we be approaching raising now? Obviously, it's going to look a little bit different. So do you have any advice?
So I think it depends on what stage you are.
Yeah.
But like just generally, like the metrics and what's changed before is, hey, are these founders great? Is it a big market? And are they growing fast? I think fundamentally, are these great founders? Is this a great team? Is this a great market? Are still there? I think what's different is there potential for growth, and what does the unit economics look like realistically? What are assumptions I'm making there? Um, so I think there's a lot more in the underlying assumption. So at the beginning is at early stages of a brand new startup, it's okay. Let me understand what this looks like. How soon can this be cash flow positive? What will unit economics be? What do I have to believe
Mhm.
there, and how much? Versus before, like, yeah, we'll just grow and figure it out when we're $1 billion revenue, right? And I think later stage, it's showing fundamental, like this can generate cash, right? So I think that's the difference, and there's a lot more scrutiny, and it's going to take a lot more time to raise. Like there's no
Yeah.
FOMO in the market. Before a hot company could raise in a week. Now I think good times 3 to 4 months. So just be ready to slug it out.
Yeah. Be ready to put in the time because it's definitely going to be a lot longer
Yeah.
journey this time around. Investor perspective, what's different about how investors are looking at startups now?
So like I mentioned, they're looking at more on the potential economics in the future, right? Like this eventually, hypothetically, business get paid for cash flows. So what do I have
Yep.
to believe the cash flows? Less, less, I guess, less variables that have to be lucky, less things that have to go right to make it work, I think.
Okay.
I think the other thing is that they probably look at different sectors differently than they did before.
Right. Do you think, in your opinion, that there are startups that are facing more headwinds
Yeah.
than others right now?
So like with going to thinking about different sectors, it's different than before. I think like
Yeah.
if you are tech enabled, um, so hey, technology is making us a better company. You know, you might have a harder time raising now because the margin, like again, low margin businesses that need scale are less likely to get raised than something like, hey, we're doing a SaaS software which gets 80% margin. I think the other area where you're seeing a lot of headwind is fintech, especially in the lending space,
Hmm.
where your cost of capital is increasing quickly. And what's that going to do to consumer demand? Are you going to be able to keep a margin? Um, and I think you'll probably see headwinds and other things that where people might see, what's recessionary pressures. Again, going like, hey, we're going to trade. There's going to be less trading volume on crypto
Right.
or stocks. Maybe prop techs that help residential consumers, retail consumers. Maybe like, hey, there's going to be less transactions in retail property. So there's headwinds in specific industries, which will make them a bit countercyclical and less like the burden of proof to raise will be higher.
Right. Lastly, we unpacked a lot here, so just high level takeaways for our community and anyone that's listening.
So we're at the end of, you'll hear this everywhere. We're at the end of an 8, 9 year bull run, 10-year bull run, whatever it's been. Particularly the last 2 years during COVID, things got a bit nutty. And I think people like, yeah,
Yep.
the good times are here.
Hmm.
And when markets overcorrect, they tend to overcorrect. And my projections is 12 months or 24 months. I haven't given those because I think no one knows. We think we're going to recession. Maybe we aren't. Maybe a year, maybe it'll be 5 years. So with the constant thing about the future, it's very hard to predict. I think that what I will predict is that we will overcorrect and there'll be more doom and gloom. And when there's the most doom and gloom and we overcorrect, will probably be the best time to be starting at a new company, starting a new
Right.
business. And I think just like when things are going well, it's keeping your head on straight. It's preparing. It's hoping. It's planning. It's hoping for the best, and being ready to take
Preparing
advantage
for
of
the
that, but
worst.
preparing for the
Yep.
worst.
Yep.
And I think there's going to be lots of friends laid off. There's going to be a lot of negative news. The media is going to love playing about it. There's going to be lots of social media about it. this is part of natural business. And so the key thing is be kind and help others out.
Be kind and help others out. I think that's a great way to end. And that's a nice note. So there's, anticipate and prepare for the worst, but obviously hope for the best. We'll have a full rundown of this tomorrow in our newsletter for anyone that couldn't join. And speaking of our newsletter, if you haven't subscribed already, you can do so at techtio.org/newsletter. As I mentioned, full rundown of everything Alex and I chatted about in tomorrow's newsletter, along with some events, news, updates. Get it right to your inbox. Monday, Wednesday, Thursday, and Friday, we have newsletters that go out. So make sure you're subscribed to that. Alex, as always, thank you for sharing your insight with us. I know myself and the community appreciates having it broken down from your perspective. Alex and I will be back next week for another edition of Quick Takes. So make sure you like and subscribe wherever you're watching or listening to this episode, and share your takes on the news with us. You can also catch up on past episodes on our YouTube and Spotify channel as well. For those that are in town next week for Collision or just in Toronto, we do have an exciting summer social series continuing on June 21st at Stacked Market. We're very excited for that one, as well as one in July, on July 7th. We're partnering with 111 for that one, and that will be at the Slip. So make sure you buy your tickets at techtio.org. We have an in real life events tab. It'll also be promoted across our social media as well. So until next week, we will see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.